A man making $35,000 a year pays more in fees, interest, and penalties than a man making $350,000. Not because he spends more, because he has less. That sentence sounds backwards. It isn't. It's one of the best documented, least discussed facts in modern finance, and once you see how it works, you start noticing it everywhere. Here's the strange part. The system isn't broken. It's working exactly as designed. It's just designed around a number most people never calculate, the price of not having a cushion. Let's follow the money. Why this matters right now. Roughly 60% of Americans live paycheck to paycheck, not people without jobs, people with jobs, sometimes two of them. And a huge share of that group isn't just short on savings, they're actively paying extra every single month for the privilege of being short on savings. That extra cost has a name inside economics research, the poverty premium. It's the idea that the less money you have, the more everything costs. Banking, borrowing, housing, even buying a bag of rice. It doesn't show up on a receipt as a single line item. It's scattered across dozens of small transactions, which is exactly why almost nobody adds it up. We're going to add it up. The visible problem: same bills, different prices. Picture two people, same city, same grocery store, same electric company. One has $50,000 sitting in savings, the other has $50 sitting in checking. On paper, they're buying the same things. In practice, they are not paying the same prices. The person with savings pays their electric bill on autopay from a checking account that never dips below zero. The person without savings occasionally misses the due date by 2 days and gets hit with a late fee, often $25 to $35, which on a $150 bill is close to a 20% surcharge for being briefly out of cash. That's not a one-time event. For someone living close to the edge, it's a monthly risk. How the system actually works. Here's the mechanism most people never get explained to them. Almost every financial product is priced based on risk, and lack of savings looks exactly like risk to a lender, even when it isn't the same thing as recklessness. A bank looking at a thin balance and a spotty credit history doesn't see hard-working person having a rough year. It sees a higher chance of missed payments, so it prices accordingly. That's why someone with poor credit doesn't just get denied a good interest rate, they get offered a bad one. A borrower with excellent credit might get a car loan around 6 to 7%. A borrower with poor credit buying the exact same car might get offered something closer to 15 to 20%, sometimes more depending on the lender. Same car, same price sticker, wildly different total cost. The hidden mechanism: cash flow is a product. Here's where it gets interesting. Banks and lenders don't just sell loans, they sell access to cash flow timing, and that access gets more expensive the more urgently you need it. Overdraft fees are the clearest example. Miss your balance by a few dollars, and a single overdraft fee can run $30 or more. If someone overdrafts several times a month, which happens disproportionately to lower-income households, that adds up to hundreds of dollars a year, essentially paid for the service of your bank, covering a shortfall you didn't plan for. Payday loans push this further. Borrow a few $100s until your next paycheck, and the fees translate into annual interest rates that can run into the triple digits. It sounds extreme until you realize the entire product is built around one fact: someone in a cash crunch has very little leverage to shop around. Compare that to a person with savings who simply never enters that transaction at all, not because they're smarter, because they never have to ask. Follow the money. Who benefits? So who's actually collecting all of this? Banks earn a meaningful share of consumer revenue from overdraft and low balance fees, a business model profitable enough that regulators have spent years scrutinizing it. Subprime lenders build entire companies around higher interest rates justified by higher default risk. Rent-to-own stores and check cashing services exist almost entirely to serve people who can't access cheaper alternatives. None of these businesses are secret. They advertise openly, but their profitability depends on a customer base that has no better option in the moment, and urgency, it turns out, is one of the most profitable conditions in finance. Who pays? The people paying for all of this are, overwhelmingly, the people who can least afford to. Take grocery shopping. A family with $3,000 in savings can buy a 10-pound bag of rice for a lower per-pound price. A family with $30 to their name that week buys the small bag at a higher price per pound, because that's what fits the budget right now. Multiply that pattern across food, laundry detergent, diapers, and household basics, and you get a documented phenomenon researchers call the poor pay more effect. buying in smaller, costlier quantities simply because bulk buying requires upfront cash that isn't there. Housing works the same way. Someone with strong credit and a down payment gets a mortgage. Someone without either option often rents instead, and in many markets, monthly rent for a modest apartment can exceed what a mortgage payment would be on a similar property without ever building any equity. They're not paying more because they're irresponsible. They're paying more because affordability itself has a price of entry, and that price is capital they don't have. Myth versus reality. The myth is that financial hardship is mostly a story about bad decisions, impulse spending, avoidable debt, poor budgeting. The reality is that the financial system charges a structural penalty for having no buffer, regardless of how disciplined someone is. A perfectly budgeted paycheck-to-paycheck life can still get wrecked by one car repair, one medical bill, one missed shift, because there's no cushion to absorb it, only credit products designed to profit from the gap. Meanwhile, a person with savings converts the exact same emergency into a minor inconvenience. Same event, two completely different price tags, one paid in dollars, the other barely felt at all. Now stretch this pattern across an entire economy. If tens of millions of households are quietly paying a premium just for being cash poor, that's not a personal finance footnote. It's a structural feature moving billions of dollars a year from the people with the least to institutions built to profit from urgency. It helps explain why wealth gaps tend to widen rather than shrink over time, even among people working similarly hard. One group is compounding savings, and the other is compounding fees. It also raises an uncomfortable possibility. Maybe the real dividing line in personal finance was never about income. Maybe it was always about the size of the gap between a paycheck and an emergency, and how much the system charges you for that gap being too small. So here's the question worth sitting with. If being broke is this expensive, what would it actually take, for one person or for an entire economy, to close that gap for good?